And for more on China's seemingly unstoppable stock market, I'm joined by Anthony Chan. He's the Chief Economist of Chase. Good to see you, Anthony.
Glad to be here.
All right, so it was a pretty eventful week in terms of the MSCI index deciding against including Chinese A shares in its emerging market index for now, at least. And not surprisingly, we saw investors pull out about $7 billion from Chinese funds. Now, that was the largest pullout in a one-week period, but the Shanghai Composite still up 2.8% for the week. The Hang Seng pretty much flat. What do you make of that?
Well, remember that Shanghai Composite Index is up close to 149% over the last 12 months. So this market has run quite a bit. The situation with the MSCI was clearly a disappointment, but that's a temporary setback. I think that within the next 12 months, we will actually see the Chinese equity market rejoin the MSCI index without a doubt.
What changes need to happen for that to take place?
Well, I think you can continue to see a little bit more liberalization. You need to see that the capital accounts opening up a little bit more. I think the Chinese already are moving in that direction. So I think it's just a matter of when, not if, it's going to happen.
Well, the rally in the Shanghai Composite, is that mostly a result of the Hong Kong-Shanghai Connect allowing for cross-border trading, or is there more to it?
I think there's more to it. That's certainly a part of it. But the other part is that we have an economy that clearly is struggling. It clearly is a little bit softer. But we also see policymakers are reacting. You've seen the government basically doubling the amount of swaps that they're doing for local government debt in order to put more liquidity into the system. You certainly continue to see more encouragement by the People's Bank of China to encourage banks to make more loans. You've seen interest rate cuts. You've seen an acceleration of infrastructure expenditures. So you're just not seeing the equity market increasing. You really are seeing a lot of things going on behind the scenes that are behind this rally in the equity market.
You know, Anthony, there's a case to be made that there are a lot of good reasons why this rally will continue. Like you say, MSCI probably moving towards including Chinese A shares, the quota perhaps being lifted on the Hong Kong-Shanghai Connect, People's Bank of China continuing with its stimulus effort. But at the same time, there are also a lot of reasons to make you take a step back and go, hey, what's going on here? China's economy is slowing down. Data seems to be pointing in that direction. Chinese investors are piling into the markets instead of housing markets. We've got mom and pop investors. We've got college students now picking stocks. And we've got Reuters saying that, you know, analysts will have that the earnings will be about 7% in 2015, and that's the lowest in 3 years. So there are a lot of mixed indicators here, many pointing to a bubble.
And actually, the mixed indicators are encouraging to me because it really tells me that the government has more to do. When you have an inflation rate that is almost 1% on a year-over-year basis, when you have the central bank really showing this much enthusiasm, when you have the regulators telling you they're trying to restrict margin trading, all those things are telling me that they're not allowing this to get completely out of control. When you have a Shanghai equity market that's actually below where it was in 2007, it still tells me that there's still a little bit more room to go.
But the Shanghai equity market is up 60% year to date. The Shenzhen market is up about 200%, 192% year over year. Are we not in irrational exuberance territory when we've got college students managing their portfolios in between studies?
I don't think it's anything wrong with having young people join the market. What I think is important is that everyone, including young students, are well diversified. For years, many of these people in China were just putting all their money into the housing market. If you put all your money into the equity market, or all your money into the housing market, or all your money into one asset class, that's not good. You want to be well diversified. That's the recommendation for anyone, including college students.
Well, what's going to happen with the Hong Kong-Shenzhen Connect when that's launched, supposedly at some point in this year? What impact do you think that's going to have?
I think that will continue to re-energize and put a little bit more energy into equity markets. But at the same time, I don't want to leave the impression that I think that equity markets will continue to go up at this pace, whether it's Shenzhen, whether it's Shanghai. You're not going to see 100% plus rates of return year after year. And in fact, if I ever see that the economy is not gaining traction and I see policymakers pulling back and not anxious to stimulate the economy, those are going to be the times that I'm going to start getting concerned. But right now, what I see and hear from policymakers is that they actually want to do more. They're accelerating a lot of the things they're doing to stimulate the economy. As long as I see that enthusiasm, I'm not worried.
Are you worried that regulators are stepping in and curbing margin trading?
No, actually, I'm very encouraged because that basically says that they will slow down some of this fervor. I think right now,
So slow and steady.
Slow and steady. I think we're in agreement that going up 149% every 12 months is not good. So anything that slows it down, balances, maybe encourages people to be a little bit more diversified, very positive for the market.
Well, you're talking about the Chinese government and its moves to open up and deregulate, and one of them will be a pilot program allowing qualified individuals to invest in global markets, like here in New York and in London and everywhere else in the world. Individuals will, of course, have to be qualified, at least 1 million yuan. That's about $160,000 of financial assets. Do you think that's going to lead to a big outflow of capital from China? These people that are investing in Chinese markets may now choose to allocate their resources outside of China?
Of course it's going to lead to some outflow, but guess what? That is the magic of investing, diversification. That's exactly what I want to see investors doing. I don't want investors putting all their money in housing, all their money in Chinese equities, or all their money in banks. I want them to diversify. So I think that that will lower the risk, because if any market, whether it's global or Chinese, have a correction, the investors are a little bit more comfortable. We want more diversification, not less.
Anthony, look into your crystal ball for us and tell me where you see the market over the next 3 months, the Shanghai Composite, and based on what? Are you counting on some more PBOC stimulus?
I am counting on more stimulus, and I expect that the market to continue to rise, but I'm actually hoping that it's at a much slower pace, because if it continues at this feverish pace, then I will start getting worried.
Okay, thank you so much. Always a pleasure. Anthony Chan, Chief Economist of Chase.